Hi, students. We'll get started with Chapter 9. So, um, Chapter 9 deals with long-lived tangible and intangible assets. And we'll look down here show you where the definition is. Right here, long-lived assets or business assets acquired for use over, it says 1 or more years, but it's really more than 1 year. These assets are not intended for resale. Very important. If they were intended for resale, they'd be inventory. Instead, they're considered productive assets in the sense that they produce the goods and services the business sells to customers. Long-lived assets, tangible assets, have physical substance, things like land, buildings, vehicles, equipment, those kinds of things. Intangible assets derive their value from some exclusive right, and that's things like patents, copyrights, franchises, software, things like that. So, long-lived assets, tangible and intangible resources owned by the business and used in its operations over several years. Now, tangible assets are also referred to as fixed assets, property, plant, and equipment, quite commonly just called PP&E for property, plant, and equipment, or plant assets. You see, certainly not an exhaustive list there, but land, buildings, machinery, vehicles, office equipment, furniture and fixtures, all examples. Land improvements is another important one. That's important, improvements to land. So things like fencing, sidewalks, drainage, landscaping, those kinds of things that improve the appearance or the functionality of the land. But the difference between them and land is they have a limited useful life. Land has an unlimited useful life. So, intangible assets, and I've already talked a little bit about them, but basically they derive their value from some exclusive right that they give the holder of the intangible asset. So, for example, the Nike swoosh. Well, that's a copyright, and you cannot use that without Nike's permission. Okay, third category, right down here, is natural resources. So things like oil and gas deposits, mineral deposits such as gold mines or coal mines or silver mines, whatever. Timber also falls into the natural resources category. Let's move on down. Here they talk about land improvements. And remember, land improvements have a limited useful life. They improve the usefulness of the land or the attractiveness of the land in some cases. Now, acquisition of tangible and intangible assets for that matter, we abide by the cost principle. And the cost principle simply says we value assets at least initially at their cost. So, how do we define cost? Cost is all cost necessary to acquire the asset and prepare it for the use that we're in, however you plan to use it. So, and that includes things like for land, cost of real estate commissions, brokerage fees, closing costs, legal fees, title searches, title insurance, all of those go into the cost of the land. For a piece of equipment, it would include things like the cost of the equipment, taxes you pay. If you have to pay import duties, those would be included. Shipping to get it to where you need it, installation cost, and even the cost of trial runs to make sure it's functioning properly. So those costs are what we call capitalized. Now, all that means is that we record them as an asset rather than as an expense. So we record them as an asset at the time of acquisition, and then we charge their cost to expense over their useful life in a process for tangible assets that we call depreciation. For intangible assets, we call that same process amortization. And for natural resources, we call it depletion. I'll talk about those later on. So move on down, and here again they talk about costs that should be capitalized when a tangible asset is acquired. All cost necessary for acquiring the asset and preparing it for use. So now here you come with a situation sometimes referred to as a basket purchase. If a company buys land, a building, and a piece of used equipment, incurs demolition, renovation, or repair costs before it's used, these additional costs are capitalized as cost of the land, building, and equipment. These costs are capitalized because they need to be done to prepare the asset for use. Now, down here they get into the idea that this is a basket purchase. We often refer to it. Now, what that means is we didn't just acquire one asset, we acquired a basket full of assets. In other words, we acquired multiple assets. So if we acquire a land, a building, and equipment all in one lump sum, we then have to allocate the cost to the various assets. Now, how do we do that? Well, we do that based on their relative fair market value. So we take each asset, we determine its fair market value apart from the others. So what is the fair market value of the land without buildings or equipment? What is the fair value of the building apart from the land? What is the fair value of the equipment? Now, let's just make it simple. Let's say we paid $1 million for them, and the fair value of the land is, let's say, $200,000, and the fair value of the building is $700,000, and the fair value of the equipment is $100,000. So we have $200,000 for the land plus $700,000 for the building. That's $900,000 plus $100,000 for the equipment. That's $1 million. So based on their relative fair market values, we would then allocate $200,000 to the land, $700,000 to the building, $100,000 to the equipment. Now, let's just say each one was actually worth more than that. Let's say the land was worth $220,000, the building was worth $770,000, and the equipment was worth $110,000. So we add all those up, that comes to $1,100,000. So how do we allocate the $1 million cost? Well, we say the land was 20% of that 1.1 million, 220,000. So we're going to allocate 20% of the $1 million to land. The building was 70% of the fair market value of the assets purchased. 770,000 out of 1.1 million, 70%. So it would get allocated 700,000, 70% of the million. And then the equipment was 10%, 110,000 divided by 1.1 million would be 10%. So 10% of the $1 million purchase price or 100,000 would be allocated to the equipment. Now, why do we have to split the difference? Well, the reality is because different assets have different depreciable lives, and so the depreciation is different for them. For the land, we don't depreciate land. The reason is because it has an unlimited useful life. It doesn't cease to be useful as land. So the building we might depreciate over a 40-year life. The equipment we might depreciate over a 5-year life. So we need to allocate the cost to each one so that we can depreciate them properly. Right here they make a difference between US GAAP and International GAAP is International GAAP treats most large asset purchases as basket purchases. So if you buy a building in the United States, we just set up the building as one asset. Under international standards, you have to take the major components of the building. So that might be the slab, the structure, the roof, the HVAC, heating, air conditioning, and ventilation system, the water system, the electrical system, whatever other major systems you identify, and allocate your purchase price between those and then separately depreciate those. Not required to do that under US GAAP. I use an airplane here as an example, and with an airplane you might have, the airplane, the structure itself, the engines is something separate, the seats and fixtures as another separate unit. The electronics might be another component. You would have to allocate the cost among all those components and then depreciate each of the components separately. You get into an illustration here using roller coaster at Cedar Fair. Cedar Fair is a company kind of like Six Flags. They own amusement parks, mainly in the northern Midwest. I've been to one of their parks, Cedar Point in Sandusky, Ohio. But anyway, here is how we would go about recording equipment. So in this case, they purchased equipment. They paid $750,000 down in cash, and then finance signed a note for the other $25 million. So what happens? We decrease cash, increase equipment, and increase notes payable. So debit equipment for the purchase price, credit cash for the amount of cash paid, and credit notes payable for the face amount of the note. Okay, there they give you an example. Here they give you the answers, so I won't go through those. You can go through them yourself. Now, they get into the idea that some fixed assets, like staplers, hole punch, box of pencils for that matter, may last for several years. Do we set those up and depreciate them? Well, the answer is no. Small dollar amounts aren't worth the trouble. They're what we call immaterial. That means unimportant. And so we just expense those as we acquire them. Whatever the purchase price is, we charge to expense. Most companies set a dollar threshold, and anything below that dollar threshold, maybe $500, they just expense immediately rather than consider it for possible depreciation. Now, one other thing here, ordinary repairs and maintenance. So you buy a truck and you change the oil, you change the spark plugs, you do just routine repairs and maintenance. Those are charged to expense as incurred. Okay, our time's about up for this video, so I'll stop there and pick up there on the next one.